Hi guys, welcome to our very first accounting lesson. Today we're going to talk about two topics. The first topic is explaining the importance of accounting and distinguish between financial and managerial accounting. And the second topic is to identify users of accounting information and how they apply the information. Now you'll be reading about this in your textbook in the module. But let's talk about first in Module 1.1, explain the importance of accounting and distinguish between financial and managerial accounting. So if you want to define accounting, accounting is defined as the process of organizing, analyzing, and communicating financial information that is used for decision making. A lot of people will just say accounting is the language of business. Some people just say accounting is the language of life because you're going to encounter accounting in any phase of your life. It does not matter what career you pursue. It doesn't matter if you're an accountant or if you're a social worker. And you'll see that in your reading today. But accounting, at some point in your life, you're going to be making decisions based on finances. For example, you're going to decide whether you want to lease a car or buy a car, or after you get out of college and you start your career, you may be looking to see whether it would be more profitable for you to take a higher paying job in a big city, or whether you want to take a lower paying job in a smaller city, because there's things to consider. It's not just your paycheck, it's the cost of living, other things in the area. So, accounting will impact other areas of life, even if you're an accountant or not. Now, the next thing we're going to do is we're going to distinguish between financial and managerial accounting. Two different things, but they deal with the same information. Financial accounting measures the financial performance of an organization using standard conventions and rules to prepare the financial reports. So, for example, you have generally accepted accounting principles that you have to follow when you record your financial information, when you prepare your financial documents, because several external users can depend on that, such as the owners or the stockholders, lenders, which is banks, and governmental entities such as the SEC or the Internal Revenue Service. Now, the SEC would be important if you were a publicly traded company and you issued stock. So people like that or organizations like that are looking at the financial documents to make sure that everything is recorded properly. Now, accounting uses a specific language to make sure everyone is on the same page and dollars mean dollars. And we will look at that in class because we'll see how the financial statements are put together so that they can be depended upon. The next thing is managerial accounting uses both financial and non-financial information such as a basis for making decisions within the organization. And the purpose for managerial accounting is to give decision makers information to assist in setting their goals and evaluating their goals, to see what information is needed, how to analyze the information, how to communicate this information with their co-workers. Information is used internally like budgeting, pricing, production cost. A lot of internal managers will use this to make sure their departments are meeting budget, or if they need to make any changes, or if, for example, they have extra funds that they could perhaps reinvest in their department. So that's managerial accounting. Financial accounting is used by people outside the company. Managerial accounting is used by people inside the company. And the next thing we're going to talk about, and you're going to be reading about, is Module 1.2, identify users of accounting information and how they apply information. So the users of accounting are generally divided into two categories, internal users and external. So the internal users are the ones in the organization who use this information to make day-to-day decisions. They're like managers, other employees. They use this information, and they will perhaps look in the past to see, are they within budget? Are the results that they are getting in line with what has been done before? Do they need to adjust their spending anyway? So that is internal users, and that's the managerial accounting. The external users are those outside of the organization who use the financial information to make decisions or evaluate an entity's performance, like your investors or financial analysts, loan officers, the IRS, auditors. There's a whole assortment of other people outside the company who look at the financial statements, and they base their decisions on how the financial statement is prepared, and they depend on those numbers. So the characteristics of financial accounting information, the information is communicated through financial statements, and we'll be looking at those later on in the class. We're not going to do it right off. But the income statement, the statement of owner's equity, the balance sheet, and statement of cash flows and disclosures are common forms that outside people look at. Financial accounting information is mostly historical in nature because they gather information from the past. You're looking at past transactions and you're compiling them into a report. So financial information is prepared using a prescribed set of conventions. They're called generally accepted accounting principles. They're also called GAAP, and they're set by the Financial Accounting Standards Board, and a lot of times that's referred to as FASB. And we will be looking at those because when the preparation of accounting documents, they have to follow these accounting principles so that the outside people can depend on them to be prepared accurately. Part of an accountant's responsibility is to quantify activities and events. They summarize and report them, and they assign a cost or a value to it, and that's called a transaction. We'll be looking at that through the course. And common computerized accounting systems, such as QuickBooks, are designed for small organizations. If you get a very large corporation, they probably won't want to use something like QuickBooks because they can't handle the large transactions. They're going to use something like Oracle. And then in this last figure, you're going to see the difference between financial accounting and managerial accounting. For example, the users of reports in financial, like we had talked about, the external users are like stockholders, creditors, regulators. Managerial, it's internal users. It's the managers of the departments, the officers of the company, other employees. And the types of reports are different depending on if they're financial or managerial, because the financial accounting is going to be more of the formal statements such as a balance sheet or an income statement, and the internal reports are going to be more informal, like a job cost sheet or a cost of goods sold report, production costs, things like that. And the frequency of reports will vary as well. For financial accounting, usually the outside people depend on them quarterly or annually. And managerial accounting, they need them more often. If they couldn't make a good decision if they only got their information once a year. So as frequently as needed is when they're going to get their report. They may get it daily, they may get it weekly or monthly. And the purpose of reports vary as well. For financial accounting, it's more of a bigger picture and external users, such as applying for a loan, getting investors, other larger decisions. And the managerial accounting is more of a smaller nature. It's assisting the internal users of the department. So it's going to be, a department compared to the entire company. And same thing with the focus of reports. The financial accounting, it's pretty standard. It's very structured. They have to follow the GAAP. And as far as managerial accounting, they don't have the constraints of GAAP, and they have more detail than the financial accounting reports because they pertain directly to a department or a section of the business. They're not as overreaching as a financial accounting report. So the nature of reports are both, for financial accounting, they're monetary. They deal with the financial position of the business. For managerial, not so much. Of course, they deal with the financial position of the department, but there's other information there as well, such as employee information and production information. So it's not necessarily all dollars. And also the verifications of reports. Financial accounting, since so many people depend on them outside the company, normally they're audited by a CPA firm. Managerial accounting, they're not audited because they are used within the company. So you see, looking through that, there's a lot of different ways to use accounting information. But it is important to either, if you are inside the company or outside the company, it just depends on the detail. So through the rest of the course, or through the rest of this chapter, we're going to address each of these, and we're going to be looking at the different reports in more detail. So guys, have a good day.